Most investors live in constant fear of losing their hard-earned wealth, suffering painful financial setbacks, because human evolution naturally wires us to avoid short-term market dangers. To find a solution, they frantically seek out common-sense advice and popular shortcuts, like relying on bonds, stop losses, or high-dividend stocks, believing these traditional strategies will protect their future. However, the Little Book of Market Myths reveals that these unquestioned truths are actually dangerous, wealth-destroying illusions that actively sabotage your long-term goals. By listening to this guide, you will learn how to question the herd and vastly improve your financial results by avoiding the costly investing mistakes everyone else makes. Listen and uncover the counterintuitive facts about the market. Stop letting fear control your portfolio and start profiting with a clear, myth-free strategy. Let's find out more.
Wow, yeah. It's really great to be here. This topic is, well, it's particularly close to my heart because it deals with something we all struggle with, the gap between what feels right emotionally and what is actually right mathematically. So we're doing a deep dive into the Little Book of Market Myths by Ken Fisher, and it is essentially a manual on how to rewire your brain for investing success.
I have to admit, reading through the source material gave me a bit of an existential crisis. It felt like every single thing I've been told by my parents, my friends, and even some financial advisors was just being systematically dismantled.
Right.
It starts with this idea that we're biologically programmed to be bad at investing.
It is a harsh truth, isn't it?
Yeah.
Our brains, they evolved in the savannah. Back then, risk meant a lion in the tall grass. If you heard a rustle, you ran. You didn't stop to calculate the probability of it being the wind versus a predator. You just reacted. Survival depended on immediate emotional reaction to short-term threats.
Right. Better safe than sorry.
Exactly. But in the stock market, that rustle in the grass is it's a headline about inflation or a dip in the S&P 500. If you run, meaning if you sell, you solidify a loss. The instinct that saved your life on the savannah actually destroys your wealth on Wall Street. The entire premise of the book is that most common sense investing advice is really just a comfort blanket for that caveman brain.
Well, let's just rip the blanket off then. We have to start with Chapter 1, which hits the biggest common sense rule of them all. That bonds are safe and stocks are risky. I mean, come on. If I want to gamble, I go to the casino or the stock market. If I want to keep my money safe, I buy bonds.
Right.
That is investing 101. Are you telling me that's wrong?
I am telling you that investing 101 might be the exact reason people run out of money in retirement.
Okay.
It all comes down to how you define the word safe.
Well, safe means I don't lose money. Safe means when I look at my account balance next month, it hasn't dropped by 20%.
Okay, sure, that is one definition. That is short-term volatility safety. You want stability. You want to sleep well tonight. And yes, historically, bonds wiggle less than stocks in the short term. But let me propose a different definition of safety. What if safety means maintaining your purchasing power for 30 years so you don't end up eating cat food when you're 80?
Well, obviously, that's the long-term goal.
Yeah.
Well, why can't bonds do that? They pay interest. They return the principal.
They do, but they face two massive risks that people ignore because they aren't as flashy as a stock market crash. The first is inflation, which we will definitely get to. The second is that bonds are not immune to losing value. We really have to talk about the teeter-totter of bond pricing.
The teeter-totter?
Yeah, imagine a playground teeter-totter. On one end, you have interest rates. On the other end, you have bond prices. When one goes up, the other absolutely must come down. They are mathematically locked together.
Walk me through that. Why does the price have to go down if rates go up?
Say you buy a bond today for $1,000 that pays you 2% interest. That's $20 a year. You are happy. But next year, the Fed raises rates and new bonds are issued that pay 5%.
Okay, so I'd rather have the new bond.
Everyone would. So if you try to sell your old 2% bond, who is going to buy it? Nobody wants your measly $20 a year when they can get $50 from a brand new bond. The only way you can sell that old bond is to lower the price. You have to discount it until the math works out for the buyer. So your safe $1,000 bond might now only be worth $800.
That makes sense. And we actually saw this play out in a really brutal way recently.
2022, it was an absolute bloodbath for the safety crowd. Inflation spiked, the Fed raised rates aggressively, so the rate side of the teeter-totter shot up. And what happened to the price side? It crashed. U.S. Treasuries, the so-called risk-free asset, lost about 17% of their value. Imagine being a retiree who put everything in bonds to be safe, and suddenly nearly a fifth of your wealth evaporates.
That is terrifying because it's the one thing you don't expect. You expect stocks to crash. You don't expect bonds to crash. But the book makes an even bolder claim about the long term. It talks about standard deviation. Now, usually when I hear standard deviation, my eyes just glaze over.
Let's keep it simple. Standard deviation just measures how much the price bounces around. Think of a man walking a dog. The man is the long-term trend. The dog is the price running back and forth, sniffing bushes, barking at squirrels. The dog is volatile.
Okay, I'm with you.
Over short periods, say a year or 5 years, stocks act like a very energetic puppy. They are bouncing everywhere. Bonds are like an old golden retriever. They mostly walk in a straight line. Stocks have a higher standard deviation. But if you look at rolling 30-year periods, the length of a typical retirement, something incredible happens in the data.
The puppy settles down.
The puppy actually becomes more predictable than the golden retriever in terms of purchasing power growth. The force highlights that over long horizons, the standard deviation of stocks drops significantly. In fact, there is data showing that over 20 and 30-year periods, stocks have actually been less risky than bonds if your goal is beating inflation.
That is completely counterintuitive.
And here is the real kicker. Bonds have never beaten stocks over a rolling 30-year period. Not once. So by choosing bonds, you are accepting low returns and, ironically, a lower probability of meeting your long-term wealth goals, all just to avoid the short-term wiggles.
It's the difference between sleeping well tonight and eating well in 20 years.
Precisely. And that leads us directly into Chapter 2, which is asset allocation shortcuts. Because even if people accept they need some stocks, they use these lazy rules of thumb to decide how much.
The famous 100 minus your age rule. I've used this. I mean, I'm roughly 40, so 100 minus 40 is 60. Therefore, I should be 60% in stocks and 40% in bonds. It feels prudent. It feels responsible. Why is the book calling this a myth?
It feels responsible because it is easy. It gives you a definitive number. But think about it. Does that formula know anything about you? Does it know if you have a massive pension coming in? Does it know if you have 5 kids going to college or none at all? Does it know if you have an inheritance?
No, it just knows my birthday.
Exactly. It treats you like a statistic. But the biggest flaw is the time horizon misunderstanding. Most people think their time horizon ends the day they retire. So the rule glides you into bonds as you get older, assuming you need to cash out at 65.
Well, don't I? I stopped working, so I need the money.
You need cash flow, but you don't need all the capital back on day one. If you retire at 65 and you are healthy, you might live to 95. That is 30 years. If you move everything into bonds at 65 because the age rule told you to, you are exposing yourself to the silent killer, which is inflation.
I think we really underestimate inflation because it's slow. A stock crash is a car wreck. It's loud and violent. Inflation is it's like termites in the basement.
That is a perfect analogy. The termites are eating the foundation of your money. Let's look at the numbers from the source. Let's say you need $50,000 a year to live on today. You retire, you move into safe bonds. If inflation runs at a historical average of about 3.5%, in 30 years, you don't need $50,000. To buy the exact same basket of goods, milk, bread, electricity, you will need roughly $141,000.
Right, nearly triple.
Nearly triple. So if your safe bond portfolio is only yielding 3 or 4%, you are falling behind every single year. You are going backward in real terms. By the time you are 85, you might be completely out of money. That is the risk the age rule ignores entirely.
So relying on a generic formula is basically negligence. You need to look at your actual cash flow needs and the lifespan of your portfolio, which includes your spouse's life too.
The spouse factor is huge. Men statistically die younger. If the husband manages the money and moves into bonds to feel safe, he might leave his wife with a portfolio that can't keep up with inflation for the extra 10 or 15 years she lives. That is a tragedy caused by a rule of thumb.
Okay, so we've established that safety is a relative term and that the standard rules are flawed. But let's look at Chapter 3, volatility and only volatility. We've touched on this, but I want to dig deeper. Why are we so obsessed with volatility?
Because it hurts. We feel the pain of a loss twice as intensely as the pleasure of a gain. This is prospect theory. If you find $100 on the street, you're happy. If you lose $100 from your wallet, you are furious. The emotional impact is asymmetrical.
So we design our portfolios to avoid that pain.
We try to. The book calls this the food portfolio myth. Imagine you go to a restaurant. You tell the waiter, I want a meal that tastes like a deep dish pizza, has the nutritional value of kale, and has 0 calories.
I would order that every single day.
We all would, but it doesn't exist. In investing, people want the high returns of stocks, the nutrition enticed with the stability of cash, the 0 calories. They want the upside without the downside wiggles. But just like you can't have the pizza without the calories, you cannot have growth without volatility.
Volatility is the price of admission.
It is the fee you pay for the superior returns. If you try to eliminate the fee by holding cash or short-term bonds, you also eliminate the returns. You incur opportunity cost.
Give me a concrete example of opportunity cost, because it feels like an abstract concept. It's hard to miss what you never had.
Let's say you have $500,000. You are scared of the market, so you put it in safe investments earning 4%. Over 20 years, that grows to about $1.1 million. Not bad. But if you had tolerated the volatility of stocks and earned roughly 10%, that same $500,000 would be worth nearly $3.4 million.
Whoa. That is a $2 million difference.
That is the price of your fear. Yeah. That $2.3 million difference is the opportunity cost. You paid $2.3 million for the comfort of not seeing your account wiggle. Was it worth it?
Put that way, absolutely not. But it's hard to see that in the moment when the market is tanking. Speaking of tanking, let's talk about Chapter 4. More volatile than ever. It feels true. We have meme stocks, crypto, high-frequency trading machines. The market feels crazier than it did in the 1950s.
It feels that way because we have a 24-hour news cycle screaming at us, but the data just doesn't support it. Volatility clumps. It comes in bursts, but it isn't trending upward over time.
Right.
Think about 2020 versus 2022. Both were incredibly volatile, but in 2020, we had the pandemic crash and then a massive rocket ship recovery. Stocks ended up 18.4%. That was good volatility. In 2022, stocks went down. That was bad volatility. Volatility just means movement. It doesn't predict direction.
The book had a funny comparison here. Onions versus oil.
I love this one. You'd think oil is the most volatile thing on earth. Wars, cartels, geopolitics. But onions, common yellow onions, they're massively more volatile in price.
Why onion?
Because of weather and spoilage. You can't store onions forever. If a crop fails, prices skyrocket. If there's a glut, prices crash. Oil can be stored in tankers and strategic reserves to smooth things out. The point is, volatility is natural. It's not just caused by evil speculators or algorithms. Even boring vegetables have volatility. And we can look back to 1933, right in the Great Depression. It was the second most volatile year ever recorded, and yet stocks rose 52.9%. Huh. High standard deviation does not mean the market is collapsing.
So if volatility is natural and necessary for growth, that leads us to Chapter 5. The Holy Grail. Everyone is looking for capital preservation and growth.
And it is a myth. It is a unicorn. If you want true capital preservation, meaning the dollar value never drops, you have to be in cash or equivalents. That means low returns. That means inflation eats you alive. If you want growth, you must accept that the dollar value will drop temporarily. You have to choose. You cannot serve two masters.
So the real strategy is to redefine capital preservation as purchasing power preservation.
Yes. Preserving your ability to buy things in the future. And the only way to do that is to grow your assets faster than inflation, which requires stocks, which requires volatility.
Okay, I want to shift gears to the big picture here. Section 3 covers macroeconomic myths. These are the things I hear on the news every night that make me want to sell everything. Let's start with Chapter 6, the GDP stock mismatch.
This is a classic bear argument. The economy, the GDP, is only growing at 2 or 3%, but stocks are growing at 10%. This disconnect is a bubble, and it must burst. It sounds so perfectly logical.
It does. If a stock market is just a reflection of the economy, shouldn't they grow at the same rate?
No, because they measure completely different things. GDP measures output, the flow of goods and services produced within our borders. Stocks represent corporate earnings.
What's the difference in the real world?
Let's look at a company like Apple. Suppose Apple manufactures iPhones in Asia and imports them to the U.S. to sell. When those phones come into the U.S., they count as imports. In the GDP calculation, imports are subtracted. They are a negative. So Apple importing phones actually hurts the U.S. GDP number.
Okay, but it helps Apple.
It helps them immensely. They get cheaper manufacturing, higher margins, and bigger profits. So the very thing that lowers GDP imports raises corporate earnings, which boosts stocks. They can move in completely opposite directions.
That is a huge distinction. I never thought about imports that way.
Also, the stock market is global. The S&P 500 companies get about 40% of the revenue from outside the U.S. So the U.S. GDP could be totally flat, but if Europe and Asia are booming, U.S. companies can still grow earnings rapidly. Tying your portfolio to the domestic GDP number is a fundamental error. And there's another trick your eyes play on you here with charts.
What do you mean?
When people look at long-term stock charts on a linear scale, the recent moves look vertical. It looks terrifying, like a sheer cliff that has to collapse. But the book points out that if you use a logarithmic scale, which shows the percentage growth rate rather than just absolute points, that scary vertical cliff vanishes. It just shows a consistent, steady upward slope. We scare ourselves with the wrong charts.
Another macro fear is Chapter 12, high unemployment kills stocks. This one really gets to me. If my neighbors are losing their jobs, they stop spending. If they stop spending, corporate profits fall. If profits fall, stocks tank. It seems like a simple chain reaction.
It is a logical chain reaction, but your timing is backward. You are looking at the present. The market is looking at the future. Unemployment is a lagging indicator. It is the very last thing to happen in a recession. Companies fire people only after things have been bad for a while.
And stocks are a leading indicator.
Correct. Stocks are like a telescope. They are trying to see 6 to 12 months down the road.
So when the headlines say unemployment hits 10%, what is the market thinking?
The market is thinking, wow, that's terrible. But the Fed will cut rates to fix it, and companies have already cut costs, so earnings 6 months from now will actually look pretty good. The market starts rallying exactly when the economic news is at its absolute worst.
The book has some crazy data on this.
It does. If you wait for the all-clear signal, waiting for unemployment to peak and start coming down, you have completely missed the boat. The returns from buying 6 months before the unemployment peak are nearly double the returns of buying right at the peak.
That is the great humiliator at work again. It makes you feel stupid for buying when the news is bad, but that's actually the smartest time to buy. And people won't stop buying things completely anyway, right?
Exactly. The source points out the resilience of consumption. Consumer spending is incredibly stable. Even in the depths of a recession, it often rises as a percentage of GDP because people still buy necessities. The economy doesn't just turn off.
Speaking of headlines, let's talk about the big scary number, debt. Chapter 13, Over-Indebted America. $34 trillion or whatever it is now. It sounds like we are totally bankrupt.
It is a big number, but big numbers are meaningless without context. If I told you I have $1 million in debt, am I in trouble?
I don't know. If you make $30,000 a year, yes. If you make $5 million a year, no.
Exactly. It's about affordability. For a country, we look at debt to GDP and the interest payments relative to tax revenue. While the U.S. debt is high when you compare it to peers like Japan or the U.K., we aren't some disastrous outlier.
And what about corporate debt? People say companies are addicted to cheap debt and it's a bubble.
Debt is fuel. If a company borrows money to build a new factory that employs 500 people and produces valuable goods, that debt is good. It creates value. If we eliminated all debt, we would choke off innovation entirely. The economy runs on credit. Fearing debt in isolation is just another excuse to sit in cash.
One more macro myth, the dollar. Chapter 14, strong dollar, strong stocks. Gets so confused here. Is a strong dollar good for stocks? Or is a weak dollar good?
Ask 5 economists, get 5 answers. The strong dollar folks say it attracts foreign investment. The weak dollar folks say it helps our exports by making them cheaper overseas.
So who is right?
Neither, or rather both and neither. The book suggests using a 4-box matrix. You look at years where the dollar was up or down and match it with years where stocks were up or down.
And what's the pattern?
There is no pattern. It is random scatter. Stocks rise about 79% of the time, regardless of what the dollar does. The correlation is effectively a coin flip. Currency direction does not predict market direction. If you are making investment decisions based on currency fluctuations, you are guessing. Stop doing it.
Okay, so we ignore the macro noise. We ignore the dollar, the debt, the unemployment rate. We focus on the long term. But now we need a strategy. And this is where people get really creative with bad ideas. Section 4, strategy traps.
Yes. These are the things that sound like sophisticated strategies but are actually traps.
Let's start with Chapter 7, 10% forever. I've heard this pitch. The stock market averages 10% a year. So invest your money and withdraw 10% a year to live on. You'll never touch your principal. It sounds like a perpetual motion machine.
It fails because of the difference between average and normal. The average is 10% over a century. But returns are almost never actually 10% in any given year.
They're lumpy.
Extremely lumpy. In fact, returns between 0 and 10%, what you would naturally think is normal, only happen about 14% of the time. Most years, the market is up big, like over 20%, or down big.
So what happens if you withdraw 10% in a year, the market is down 20%?
You are cannibalizing your portfolio. You are selling assets at a low price just to pay your bills. If you do that for a few years in a row, like in the early 2000s or 2008, you dig a hole so deep you can never climb out. It's called sequence of returns risk. If the bad years happen early in your retirement, the 10% withdrawal rate will bankrupt you.
So people get scared of that, and they swing to the other extreme. The CD strategy. Chapter 7 also touches on this. Just buy CDs, 5% guaranteed.
It works right up until the CD matures. That is the trap. Let's say you lock in 5% for a year, great. But next year, if rates drop to 2%, your income is instantly cut in half. You face reinvestment risk. And meanwhile, inflation is chewing away at your principal. You aren't growing.
Okay, so the middle ground seems to be dividends. Chapter 8, high dividends for sure income. This is the absolute darling of the retiree community. By big, boring companies that pay fat dividends, it feels safe. It's like a rent check.
It feels safe, but there is a massive misconception. Dividends are not interest. They are not guaranteed. They are discretionary payments decided by a board of directors.
They could be cut.
Boeing is the example the source uses. For 78 years, nearly a century, Boeing paid a dividend. It was as reliable as the sunrise. Then came 2020. Pandemic, travel shut down, massive financial stress. What happened?
They cut it to zero.
Overnight. Gone. If you were a retiree relying on that sure income to buy groceries, you were in serious trouble.
Plus, if you only buy high dividend stocks, aren't you limiting your options?
Drastically. You are ignoring huge swaths of the market, like tech and biotech, that reinvest their profits for growth instead of paying them out. You end up with a portfolio that is heavily concentrated in slow growth sectors, like utilities or tobacco.
But I need cash flow. If I can't rely on dividends, how do I get cash?
The book proposes a concept called homegrown dividends.
I love this term, but it really scares people. Explain it.
It simply means sell a few shares.
But that's selling principal. That's the cardinal sin. Never touch the principal.
That is the mental block we need to break. Mathematically, there is zero difference between a company paying you a $1,000 dividend and you selling $1,000 worth of stock.
Prove it. Walk me through the math.
Okay. Say you own 100 shares of a company trading at $50. Your total value is $5,000. Scenario A, they pay a $1 dividend per share. You get $100 in cash. But when a stock goes ex-dividend, the share price drops by the exact amount of the dividend. So the stock is now $49. You have $4,900 in stock and $100 in cash. Total wealth is $5,000.
Okay, I follow that.
Now, scenario B, no dividend. Stock is $50. You sell 2 shares. You get $100 cash. You have 98 shares left at $50. That's $4,900 in stock and $100 in cash. Total wealth is $5,000.
It's identical.
Completely identical, except homegrown dividends give you control. You decide when to sell. You decide the tax timing. And you can hold a globally diversified portfolio of growth stocks and value stocks, creating income from whichever part of the portfolio has gone up the most.
That is a total mindset shift. It liberates you from chasing yield.
Yeah.
But people love chasing what's hot. Chapter 9 is about the perma superiority of small cap value, or really whatever the flavor of the month is.
There is always a cult following for specific asset classes. Small cap value beats everything. Emerging markets are the future. Historically, yes, small cap has had great runs, but nothing is permanently superior.
Everything moves in cycles.
It's basic supply and demand. When an asset class gets hot, Wall Street creates more of it. Investment bankers launch more small-cap IPOs to feed the frenzy. The supply floods the market and returns naturally cool off. If you chase the permanently superior asset class, you are usually buying at the very top. You are just performance chasing in disguise.
And finally, the worst strategy trap of all. Chapter 11, stop losses, stop losses. It's in the name. It sounds so responsible. I'll buy this stock, but if it drops 15%, I'll automatically sell to prevent a disaster.
I call the stop loss the guaranteed loss maker.
Why?
Because stocks don't move in straight lines. They jaggedly move up and down. A drop doesn't predict a further drop. Often, a drop is just noise in the market.
So what happens with the stop loss?
Say you set a stop loss at 10% down. The market has a bad week, dips 11%, triggers your sale. You are out. You are in cash. Then the next week, the market snaps back up 15%.
A whipsaw.
Exactly. You sold at the bottom, you locked in the loss permanently, and you completely missed the recovery. You have turned a temporary fluctuation into a permanent destruction of wealth. Stop losses, stop gains far more often than they prevent crashes. They are a tool for day traders, not long-term investors.
This brings us to the final stretch. Section 5, timing, turmoil, and trust. This is the emotional battleground. Chapter 10 discusses the myth. Wait until you're sure.
I hear this constantly. I'm nervous. I'm going to sit in cash and wait for the smoke to clear. I'll get back in when the economy looks better.
It feels prudent. Why catch a falling knife?
Because clarity is the most expensive thing in the market. By the time the smoke clears, the prices are already up.
We mentioned the V-bounce earlier.
Yes, the initial recovery from a bear market is violent and explosive. The source notes that the first 3 months of a new bull market average a 24.3% return. That is a massive chunk of your lifetime gains happening in just 90 days.
And if you are waiting for clarity, you were sitting on the sidelines for those 90 days.
Exactly. You missed the launch, and you can almost never make that up. To capture the long-term returns of the market, you have to endure the uncertainty of the bottom. You have to buy or at least hold when your stomach is churning.
But the world is a scary place. Chapter 15, turmoil, troubled stocks, wars, pandemics, political polarization. It feels irresponsible to invest when the world is quite literally on fire.
It feels that way. But look at history. Chapter 15 walks through the timeline. World War II, the Cold War, the Cuban Missile Crisis. We were inches from nuclear annihilation. The assassination of JFK, 9/11, the 2008 meltdown, a global pandemic.
And what did the market do?
It went up, not every day, not every year,
Yeah.
but over the long haul, it went up relentlessly.
Why? Is the market just heartless?
No, the market is resilient. It represents the collective ingenuity of humanity. Companies are problem-solving machines. In a war, companies make weapons and logistics. In a pandemic, companies make vaccines and remote work software. The profit motive drives adaptation. Betting against the market is betting against human ability to solve problems despite the bad news. The market prices in known fears very quickly.
That is a powerful way to frame it. But while we trust the market, we shouldn't trust everyone in the market. Chapter 17, too good to be true.
Ah, the fraudsters, the Bernie Madoffs of the world.
How do we spot them?
The biggest red flag is consistency. Paradoxically, as humans, we want consistency, but in finance, consistency is impossible.
Madoff posted returns of like 1% every single month, never a down month.
Right, 10 to 12% a year, every year, like
Wow.
clockwork, regardless of market conditions. In a real equity market, that is statistically impossible. If someone promises you stock-like returns with bond-like stability or zero volatility, run away. It is a fraud.
The book also mentions crypto here, Terra USD.
Offering 20% guaranteed interest. Think about that. In a world where risk-free rates were near zero at the time, how can you generate 20% risk-free? You can't. It was a lie. And it collapsed, wiping out billions.
So what's the practical tip? How do I ensure my advisor isn't Bernie Madoff?
The custody rule. This is simple and highly effective. Never write a check to your financial advisor. Never give them custody of your assets.
Where should money go?
To a third-party custodian,
Right.
a big, boring bank or brokerage firm. The advisor should have the power to trade the account, but never the power to withdraw money from it. If the advisor and the custodian are the same person, like Madoff was, that is the danger zone. Separation of powers keeps your money safe from theft.
That is incredibly actionable advice. Okay, we have covered a massive amount of ground today. We've debunked the safety of bonds, the age rule, the fear of volatility. We've tackled macro myths about GDP and debt. We've dismantled strategy traps like stop losses and dividend chasing.
We have basically taken the entire common sense rulebook of investing and thrown it right out the window.
It's a lot to process. What is the one big takeaway for the listener?
Humility.
Humility.
Yes. The market is the great humiliator. It exists to humiliate the herd. If everyone believes something like high unemployment kills stocks, it is likely wrong. The herd is driven by that evolutionary fear we talked about at the very beginning.
The caveman brain on the savannah.
Right. To be a successful investor, you have to be humble enough to admit that your instincts are wrong. You have to be willing to feel uncomfortable. You have to embrace the wiggles, the volatility, and the uncertainty, because that is exactly where the profit comes from.
The antidote to fear isn't safety, it's knowledge. It's understanding why things happen, rather than just reacting to what is happening. Here's a final provocative thought for you to mull over. If human evolution wired us to be bad at investing, what other modern systems, like our diets, our social media habits, or our work schedules, are we also navigating with the savannah brain? If we can rewire ourselves to conquer the stock market by looking at the data instead of the fear, maybe we can apply that same analytical humility to the rest of our lives. Something to think about.
Ideally, yes, question everything. When you feel that knot in your stomach telling you to sell, realize that is just your biology trying to save you from a lion that isn't there.
Yeah.
Stick to the plan. Trust the long-term data, not the short-term emotion.
This has been an incredible deep dive. I feel like I need to go apologize to my portfolio for all the times I stressed out about it.
Your portfolio will forgive you as long as you leave it alone to grow.
Thank you for watching. Please like, out, share, subscribe, follow up in the next video.